Rick McBride here with your Property Masters and 5 minutes of free time. McBride Realty Group. Was watching CNBC this morning, and they were reporting on market sentiment. And those numbers were down 2 points. Not sure what that means. For the first time in quite some time. Additionally, yesterday the Fed hiked interest rates another quarter point. So what I wanted to do is take a second and see how this will affect the market and what does it mean for you. It's been a rush to the market over the last few months. That's quite an understatement, actually. This has caused a spike in the market, up in some areas 20-25%, especially in the lower priced portion of the market, where the first-time home buyers tend to live. First-time home buyers essentially had disappeared from the market during the crash and in the early 2010s. There's a lot of pent-up demand out there from those first-time home buyers, and additionally from those trapped in their houses during the crash because their value of their property went down, so they could not sell it. They were upside down in their house, kind of like when you get stuck in your car. Only when you take your car to the dealer, they'll often just finance it in the next loan. You can't really do that with a property. The bank won't do that. So during the downturn, what happened was investors supported the market. The volume, the total number of properties that sold, never really changed. It actually kept going up. What changed was the price per property, so the total overall market. Investors bought up as many properties as they could afford at rock bottom prices. These homes are now rentals, and they're returning 20+% for these investors. They bought it for, say, $25,000-$30,000. They're getting $900 rent. That's a 30% or 300% return they're getting, really. But they're getting a substantial return across the board on their investments. They're not likely to sell anytime soon. Those who are fortunate enough to be able to get loans during the crash and buy during the downturn, or maybe had cash and bought during the downturn, have absolutely no reason to sell. They have two reasons not to sell specifically. One is they got a great deal. Why would they sell? Second is they got a great interest rate, and they're locked into that great interest rate for 30 years. They have no desire to move or sell at this time. And finally, anyone who is fortunate enough to do a half a refinance or a traditional refinance or anything during the crash, they're unlikely to sell because their rates are so low. All these low rates, the mortgages these people are paying on their properties, I mean, they would be dumb to move unless they just really want to move or they have to move for a job or something like that. So rates should continue up according to all of the economists. Not sure at what pace, but they're likely to continue up in the near future. So this means with all these people with great rates, unlikely to sell. Even if they bought another property they're unlikely to sell, they might consider renting it because they're going to make so much money in cash flow. So we can debate whether the Fed should be raising the rates or not at this time. Doesn't matter what we think though, they did it. While this does not directly affect mortgage interest rates, it does affect where banks want to invest their money. If they can get more from a T-bill than issuing you a mortgage, then rates tend to rise because there's a risk and much more risk giving you a mortgage than buying a T-bill. So they want to compensate for that risk by charging a premium rate. So typically as the Fed raises rates, rates go up. Over the last few rate hikes, though, mortgage rates haven't gone up as much as the rate hikes. So we wouldn't anticipate this to last forever. Rates will continue to creep up, making existing mortgages and their rates more inviting. This will cause less people to move and decrease demand. Market sentiment moving down indicates demand will start to drop off. We're seeing this locally. The market is taking a breath and reevaluating. This is not a rush. There's not a rush into the market unless a property is competitively priced or offers something substantially unique. With dropping demand, It's crucial that you hire an experienced agent who can identify the characteristics that make your property stand out. Proper marketing campaign that focuses on what makes your home great will assure you that you get top dollar for your property. Our Masters Marketing Program does just that. Call or text us today at 386-866-1007 to put our Masters Marketing Program to work for you. We get you top dollar for your property or business. And as demand decreases, marketing will become more and more and more important.